think record. Awesome. Okay, cool. All right, guys. Thanks for jumping on. Appreciate that. I'm sure we'll have a few people jump in. But I think, plenty of you guys have introduced yourselves in the past. So, I mean, I think we all know who we are now. Obviously, Jamie, Great Lakes Capital Group. But our goal really is to work with our investors to purchase apartment complexes. So we do that with syndications. So I thought it'd be pretty cool just to have kind of a summary of really what a syndication is and some of the structures of it, what's something you might see inside of it, some of the fundamentals of what's inside of a syndication rather, and answer any questions that anybody might have. So with that, and obviously we have some wonderful people on here who have experience doing all of this. So that's what's great about having a team like this. So, fundamental wise, syndication usually has some type of object, entity, or asset inside of it. I've heard people who syndicate a horse. So you can really syndicate anything. But in our situation, we're gonna syndicate a real estate asset. Something that John and Gary have done with the syndication is 48 unit apartment complex. So that's kind of what we're shooting for, apartment complexes. So you'll basically have a description of the real estate asset that you want to purchase. You're going to have a layout, kind of a business plan and what the opportunity is, information about the market and the area that the property is in. Usually you're going to have some type of timeline that the syndicators have to go through so they can meet their dates and get everybody into the closing table and completed. Inside that information, you'll have pro forma metrics. So there'll be like an analysis about what the opportunity looks like for that deal, and usually a timeline in terms of how long they might own the property. Maybe it's a 5-year hold, 7-year hold, 10-year hold, things like that. And they'll probably talk to you about where you can get the operating agreement, the LLC, the PPM documents that eventually, any investor who wishes to invest in the syndication has to sign. That pretty much sums it up, right, Gare? John?
Yep. I actually met somebody that syndicated parking lots last year.
Really?
Yeah.
I never thought.
He was doing well too. He set up a booth at one of the conferences John and I attended. Yeah. Huh. Syndicate anything you want.
Wow.
They were. He was buying parking lots, and then they leased them out to those parking pros, that would actually run the operation. But yeah, depends on, I don't think you're going to make much money in Rochester, but
yeah, right.
Syracuse.
Well, that's interesting. I haven't heard that one yet. That's pretty cool. Mobile homes, everything else, but not that. That's cool. All right. Jay, nice.
You wonder if that model with COVID has been really hit hard because businesses downtown are not necessarily, people aren't going there, right? So I'm sure that model has probably been shaken a little bit.
Yeah, I would imagine so. I think you're gonna find somebody who needs to live somewhere first before they need to park somewhere. So, yeah.
Also, might turn the market into a better opportunity too. Whoever's ready, willing to buy those deals from somebody.
That's true. It's very true. Yeah, but yeah. So, like they said, syndication, lots of different things that can be in it. We'll focus on apartment complexes, mobile home parks, storage, but that's traditionally what I see a lot of people that we're around. We see them do. So yeah, syndication really is just a way of pulling your money together as a group to purchase a larger asset that typically you couldn't buy by yourself. Some of the stuff we look at could be $5, $10, $15 million. And I know I can't buy that by myself. I don't have a rich uncle. So it definitely is great to work with other people to own a piece of that pie. So, in terms of really what's inside of a syndication, typically what you'll see is two different parts. You'll see your limited partners that just invest. They just provide capital equity, and then they just want a return on their money. And then you'll see the general partners who basically manage the asset. They find the deals. They do everything pretty much to bring the opportunity to the limited partners. And some of the common things that I've noticed, common structures you might see in a syndication, I will be honest, it's really up to the syndication, the person doing it. It's up to their discretion, how they want to structure their deals. But some of the common stuff we've seen is a preferred return, where basically a certain percent gets paid back to the limited partners first before anybody else gets paid. And that can range between 5 to 10%. It kind of depends on the structure of the deals. And some people don't do preferred returns either still. So it just depends on that, but that's kind of a common thing. And then general partnership, you might see like a 30, just think of a pie, 30% might be the GP owners and the rest of it, 70 would be your limited partners. Sometimes you can see different numbers. Again, it really depends on the structure and the syndicators and what they do. You guys, what did you guys do for the Fontiac? I don't remember.
We did a 75-25.
Oh,
So
yeah.
we gave a little bit more to the investors, and just the way that we wanted to do it, to make sure our investors, we're very happy with the deal.
Cool. Yeah, I think our I gotta double check, but I think we did maybe like an 80-20, 75 or I think it was either 75 or it was 80 for our 60 unit in Ithaca. So I'll have to check that. But yeah, so yeah.
It all depends on the returns and how good the deal is. If you've got a really good deal and you're able to offer a double digit return to the investors, then you can certainly play that or play around with that distribution a little bit.
Sure, exactly. And I'm even seeing now, especially some of the ones I get emailed, multiple classes, like a class A, B, or C. And for example, maybe you just want to put some money to work and you're just going to get a straight 10% return on your money. That's it. You don't see any upside in the deal or nothing. You just, hey, I have 100 grand. I want to get 10% return on my money each year. That's it. So that might be a class A. Class B could be more the model here where you have a preferred return and then you might have a part of that split. So I'm seeing more creativity with some of the syndications now as well. And typically you're going to see a minimum amount for whatever class you might have. You'll see a minimum amount. It could be 25,000. It could be 50. I've seen 100. I've seen for some of the class A's like 200,000. So it really, again, it depends on the syndicator and what they want to do.
And then back to the district, the split, I've also seen it where that can change, based on the performance of the product. If the general partners are doing, exceptional well in managing the property and, they're able to return, exceeds what they had proposed or whatnot, then, they can actually, change that distribution, a little bit differently. It could end up, being a 50-50. So, but, as long as the limited partners are, happy with what they're getting, and the general partners are out there, trying to turn the property to make it actually, perform, extra well, and they end up getting a little less piece of the pie later down the road, but they're still getting the same return. It doesn't really make that much of a difference. So it's a little more of an incentive, I guess, for the general partners to, work extra hard and make sure that that property performs, but they can change, ours is just, throughout the life of the product is still going to be the same. It's never going to change. You're always going to end up, our investors are always going to have 75% of the deal.
Right. Yeah, no, that's a great point. I forgot that when you hit certain milestones, you could have it alter. Yep. Great point. All right. So just another quick example, kind of a representation on a pie chart and with a little more info. Obviously, anytime we go and purchase a property, we always create an LLC that controls the deed of the actual property itself. And inside the LLC, where we start creating the structure for how we do the general partnership and the limited partners. So again, limited partners typically are people who are looking to put their money to work. They're just too busy. They have jobs, they have other things going on, businesses, kids, all that fun stuff. So they don't really have the opportunity or time to find larger multi-million-dollar buildings to purchase, but they want to be able to own some of that stuff. So they just provide that equity, and whatever proportion they put in here, they'll get that proportion of that pie inside here. And then general partnerships, again, they do all the due diligence. There's different people in the GP. We can talk a little bit more on the last slide about some of the functions inside the GP. But there's different roles and responsibilities depending on your group and how you divide them up. You might bring somebody in who just is very wealthy and wants to be a loan guarantor on the balance sheet, and he can get a percentage of that pie for that function. So there's lots of different things: raising capital, doing due diligence, lots of different aspects of the GP, depending on how and what resources you might need as a group. Anything you guys want to add to that?
As you might share as well, Jamie, I'm a limited partner on 2 other deals. I'm in a couple of syndications that I'm a limited partner on, and those are easy. You just look for your distribution. There's no work to be done. It's I'm getting a good, very good return on that, and it's absolutely just the only thing you need to do is make sure your distributions are being deposited into your account, as you expect. On the general partner side, John and I are on the Tipperary Hill Apartments, as we renamed the Frontenac. And there's a ton of work, a lot of work that goes into that, never to be underestimated. I mean, everything from, working with the CPA to make sure that, your bookkeeping is done and everything is, managed as far as the asset goes, managing the property manager to make sure that they're doing their job. There really is an awful lot of work to make sure that that asset is performing, and a lot of responsibility to go along with that too. So when you've got vacancies and issues such as COVID, that stuff there is stuff that we worry about. Or you make sure that they don't become a problem, right? You're making sure that units are being turned over and they're collecting the rents. Whereas again, on the limited partner side, I don't think about those properties. Those guys are managing them, and I'm just collecting the money, mailbox money, right? So, pros and cons to both. There's a bit of a reward on the GP side. You do get a slice of that pie, but there's a lot that goes along with it, and you can be part of the general partner by being, as you were saying, a balance sheet guarantor. So let's say somebody, you're acquiring a property that's much larger than what the syndicators can take down, because their net worth needs to be the value of the mortgage that they're taking out. You can bring in a balance sheet guarantor that is has a very high net worth, and they can get a general partnership just for signing their name. So that's a nice way to go about it.
Yeah, no doubt about it. Like you said, it's definitely a team effort, and the whole goal of the team is, just get ahead of all those problems, try to see those problems coming, and even underwrite it in a conservative way. So if those problems come up, they won't impact your ability to meet your returns. Yep. Let's see. All right. So, I want to kind of give an idea of what our team might go through and how you guys would experience it with us. So, as an example, let's say we found a deal tomorrow. Maybe it's a 100-unit apartment complex, and we're negotiating with the owner, and the owner says, okay, yep, I like this price. We're going to submit an LOI. They accept it. Great. The moment, that pen gets put on the paper, immediately our due diligence period has to start, where we have to go through and start inspecting the property, going through all the financials, everything. Look at all the units, make sure that there's nothing that's going to jump out at us after we purchase it that we didn't see. If you find, a couple roofs that might be completely shot, and now you got to go back to the closing table and negotiate different prices because of things like that. So while that's going on, though, typically what we also want to do is create some type of offer memorandum document that basically we can provide our investors to say, hey, we have a property under contract. Here's a business plan. Here's how much we're looking to raise. And here's how we want to kind of shape the investment opportunity, the syndication. And when we provide that document to you guys, you want you to review it. Sometimes you might do a Zoom call. Sometimes you might do a YouTube video. There's lots of different things and lots of different approaches to how you can communicate this to your investors. But essentially, they're going to go through that content, and they'll decide if they want to potentially invest in that deal or not. So, you guys want to add anything else to that?
Well, just a little bit about the due diligence. So there's something that they refer to as your money going hard. So when you sign the contract, they're looking for earnest money. So you would put down, I've seen 3%. Lately seems to be 3 to 5%. So it's a significant down payment. Once your due diligence period is over, meaning that you've gone through the property, you've done all the inspections, your period or your time frame for backing out and getting your earnest money is over. There's that period where your money is hard and you are now committed. If you walk away, you lose all that, you lose your down payment. So generally at that point there, the syndicators or the general partners are the ones that put the money up. So, you're taking the risk, or, in this, our case, we took the entire risk. And if that deal didn't close due to our non-performance, we completely lose that money. And some of the crazy stuff that we've seen lately, just because it's such a seller's market out there, is that some of the sellers are requesting that the money go hard the day you sign the contract, meaning that there's no way for you to get your money back. You're committed. And if you back out, or you find something that, you can't renegotiate, it's too bad, and that's just really tough pill to swallow. But I'm seeing a lot, hearing a lot about that. I just can't fathom that, that risk of, it's basically a sight unseen, right? I mean, you don't know anything about the property. They want you to put your money down, and your money goes hard on day one. So it's crazy. But
it definitely is crazy. I mean, I definitely have heard some pretty tall numbers for EMDs, anywhere from 100 grand to almost $1 million. So I've seen some people try to do. Obviously, if you have a very competitive market, you're going to see things like this. But that's part of the reason of getting organized, right? That's why it's really important to build your team, build your investor database, get to know everybody, because when it comes crunch time and you have days ticking down, you want to be able to get all this stuff together. You want to be able to get your investors on board and collect your funds and get all the funds where it needs to be so you can close on the asset. But yeah, you're absolutely right. Those once you sign that paperwork and as days start ticking down, 30 to 60 days, usually due diligence, I've seen people try to get it done in 20 days. Like they'll try to literally do due diligence on a 100 to 400 unit apartment complex in 20 days. It's crazy. And then usually you might close within 60, maybe have an extension 90, somewhere in that range. So it depends on the last 30, 60 days might be you just getting your mortgage stuff all figured out, and your funds might almost be in place, but just getting all the documents completed and all the attorney stuff going back and forth, really. But yeah, pretty amazing stuff to see it done sometimes that fast, but also a little scary too. Yeah, so I mean, the offer memorandum, I actually have an example here. I just want to show you real quick. To Gary's point, I actually am a limited partner investing in 2 different apartment complexes. I also am an LP and a GP in our Ithaca property as well. And then I just own the LLC, part of the LLC for our 24 unit. But this is a pretty useful document. I mean, it pretty much is going to outline quite a bit of stuff. It just doesn't have anything that you actually sign. It's just all informative. It's just basically for a potential investor to read and just get a feel if it's something they want to do or not. But basic summary stuff that you might see in here is, investment highlights, property overview, financial analysis for sure. It's going to talk about the market. So you might be purchasing something like, for example, in Raleigh. So you're going to want to bring some information to the table that talks about why Raleigh wouldn't be a good market to invest in an asset. Might have some comparables. So I might compare to other properties that are in a similar class. That kind of helps show you the opportunities sometimes. If you have if you're buying a Class B apartment complex and you compare your Class B to a few other Class Bs that have been renovated, and you can look at the difference maybe with either expenses as well as income, things along that line. And then there might be some definitions, like a little appendix that kind of describes what some of the terms are. A timeline. It's really important just to make sure you communicate your timeline to your investors, just so that way they know. I think Gary and John, I think you might have experienced this where some people wanted to invest in your deal. They kind of waited and waited. And then finally, you guys filled it up and said, sorry, we filled up. We have no spots available. So it's important to understand the timelines. And then obviously contact information. So show you another quick one right here. So this is actually a deal that I invested in 2018. It's a 398 apartment complex. It's actually in DFW, Texas area. But just real quick, it's going to have your general overview. It's going to have pictures inside of it. This is something that I'd like to be able to put together for us as well when we find an asset like this. Quick summary, like I was saying. and it's going to get into it. It's going to kind of talk about the opportunity. What is the asset? It might even have a little bit about a financial projections maybe, or the loan options appear in the front. Excuse me. But they'll get into more detail and further. It might have different examples of investor returns. And again, in the financial section, it definitely will have this. So this is more summary. So it kind of talks about some of the opportunities. It might say something like different loan options. So these guys are one of the business plans. They didn't underwrite this, but one of the ideas is that they could do a supplemental loan maybe after 2 or 3 years because they've created enough equity in the property. So instead of refinancing it and dealing with all the different penalties, they might be able to do a supplemental instead. So back to what Gary said earlier, here it's a 70-30 split. And then after they reach a certain projection, now it turns into a 50-50. So they're just, they're mentioning that in this document here. So people are aware of that. Looks like they're projecting a 7-year hold. So, you can just kind of go through this. So this thing's 60 pages long. So, I mean, you can kind of go through and just read different things, how much money they might want to spend per unit, a breakdown of cost of what they're trying to do per unit, what they might be trying to do outside the property, just different ways that you're trying to improve it, different ways you're trying to either reduce expenses or bring up income. So, a lot of stuff there, but it's just, this is kind of a somewhat typical document that you might see if you're choosing to invest in real estate syndications. And they might have a before and after picture possibly of like a renovated unit versus non, or they might tell you about what some of the things they might try to do. So this is common things that I think a good syndication team does. They try to be transparent. They provide as much information to the investor, let them know that this is what they're trying to do. It's not really any different than when you're trying to buy a duplex and do something very similar. It's just that it's just you doing it really. But in this situation, someone else is doing it for you in a way, and you just kind of want to see what they're doing. So they're outlining a business plan, and they're just providing the details of how they do that. So again, this is not a legal document. They're just basically, there's nothing here you sign. This is just for your information. Here's the content. Here's what we're trying to do. But most likely the business plan is going to stick pretty close to that. Obviously, you want to be conservative in different ways because something like COVID could come up. So you can't put that in your document, but if something like that comes up, then you just have to be prepared for it. And the way you're prepared for it is basically the kind of debt that you put on it. Is it debt heavy? Is it not? All that kind of fun stuff. So there's lots of different ways that you could approach your underwriting to be conservative. So that way you can get yourself out of jams like, like COVID, for example. So these guys had a breakdown. So just good stuff. But yeah.
Hey, Jamie, quick question for you. You might not have the answer, but I noticed the debt and equity stack, on the purchase price. And what I found interesting was they indicated, seeking a low leverage agency loan.
Yeah.
And the interesting thing is they chose 68%, which is actually, tier 2 agency, Fannie pricing, which puts you which is basically, anything from 66 to 80% LTV and a minimum of a 125 debt coverage ratio. Okay. If you get down to 65%, now you're what's considered moderate leverage. And at the very least, you're saving yourself at least 25 basis points on the interest rate.
Oh, nice.
So so when you're borrowing, when you're trying to raise that much equity and put that in there and then talk about doing later doing a supplemental. Now, the interesting thing is that, and maybe the rationale for doing that and leaving leaving the leverage where it is because the agencies also have something that I learned not long ago, and it was a learning experience. But they have what's called tier dropping, TIER dropping,
right?
Okay, which actually involved a lot of TEAR dropping, because, and I'm being facetious, but in any event, what Fannie says, if you go in and you borrow at 65% or at 64%, you can't then come back to them and ask them for a 70% loan or a 75% loan. Well, you can, And if you do, then what they do is they reprice the entire debt, the whole stack, on what the interest rate would be if you were to borrow at 77% or 73%.
Oh, wow.
And all of a sudden your 3.8% interest rate or 3.4% interest rate is blown away, because now you've got the extra 50 on a second mortgage, because the pricing's a little bit higher. But then if interest rates happen to be, let's say 460, they're gonna reprice everything so that the weighted average yield, okay, is 460. So you're 340. So it's not like, hey, you know, we're happy we've got a 340 and now we've got a 460. No, the whole thing gets repriced so that everything becomes, so really the interest rate on the second, you know, might be, you know, 9.5%.
Right. Yeah.
So that may have been the rationale for doing that, thinking that they would go back, you know, for an equity pullout for the, you know, for the benefit of the limiteds.
Yeah, I'm sorry, you were saying that if you have a lower LTV,
Yep.
that they'll reprice both the supplemental and the original loan if it's.
They'll reprice the supplemental to take into account what the entire loan would have been had you come in and asked for a 77% first mortgage.
Hmm.
Huh.
It's called tier dropping.
But you're saying they'll reprice the original loan too?
No, well, they can't,
No.
because it's already securitized and
Yeah.
off to investors.
Right.
But don't they do that anyway? Isn't the supplemental based on market conditions when you retake it, when you take it out again?
It is, but if you stay within your tier,
Yeah.
if you are at 60, if you start at 65 and then after.
Oh, your supplemental's got to still be in the same range is what you're saying?
Yes.
Gotcha. I understand.
That's what happens. Your supplemental, you can't start out at 65% and then say, hey, you know, we're doing so well and the property's appreciated. And that's another thing. They really, you know, the agencies don't want to hear the whole cap rate compression and the property appreciated. If you can document that it was a repositioning and you've had a lot of success, you know, growing your rent roll and growing your effective gross income and your NOI, they'll listen to that story. But if you take the same, you know, $784,000 of NOI, and now all of a sudden market conditions have taken cap rates from 6.6 to 5.7, they don't want to hear that story.
Yeah.
I mean, you'll get a lot of pushback from, you know, from the lenders to say Fannie just doesn't want to participate in that.
Right. I would wonder why they would want to actually have such a low LTV anyway. I mean, the cost of borrowing that, you know, that money is so low. And if you took out extra, I mean, you can add improvements to the property, you know, unless they're just, they can't get the DTR, you know, debt coverage or DCR down low enough. That's why they have to, you know, if they're forced to take a low LTV because of the DCR, I can understand that. But other than that, I'd be like, it's cheap money. Borrow as much of it as you can, and then put that into the property to help improvement and drive up their NOI.
You know, it's interesting. So I never really worked, you know, directly with home properties on the financing side, but they were a perfect example of, you know, they'd have credit lines with Fannie and Freddie, and you know, they'd have packages and 4 properties would securitize, you know, 1 line of credit or whatnot. They were using their balance sheet, but you know, they would typically be sub 70 and oftentimes as low as 60. The private equity firms that buy the Class A properties, you know, they do that. You know, I've got a friend and a good client, you know, who's based in Albany, but I sold him a large complex in Syracuse, and we just caught up a couple weeks ago, and you know, he doesn't want anything in his portfolio to be north of 65%.
Yeah,
You know,
I actually think it's not terrible to do that. I mean, it does open up lots of different opportunities. I think part of the business plan here for them is I know that they're rolling into what's it called, the 1031 exchange. So they were actually selling another asset as well to enrolling it into this. So that could have been part of the reason why they might have been messing with those numbers at that level as well.
Sure.
But that's the cool part about it. I mean, it's really important to have on your team, you know, working with a mortgage broker or somebody who's really knowledgeable, because there's so many different ways you can structure these things. It's pretty amazing what you can do with this stuff now, which just makes it that much more cool to work with on commercial.
Just not having one flavor of ice cream, right, Jamie?
Yeah, earlier conversation. Yeah.
Liking the whole buffet.
You got it. Yeah.
So
So
just curious, back on that slide you were just showing there on
Sure.
that page, I think there was 3 different, or at least it was 2 different average annual returns. Oh, I guess it says excludes proceeds from the sale,
right.
and 1 includes proceeds on the sale.
Right.
Okay.
Yep.
So once they sell the property, they're up in the double digits. Okay, interesting. Okay.
Yeah.
How they
And
broke that
I
out.
when I was actually down in Texas, well, not 2019, I think it was. I think it was 2019. And it's all blurred now. 2019, I'm pretty sure. I actually toured it. Maybe doing really good with it. You know, they're just lightly renovating all the stuff they need to do. They're hitting their points, and they're making returns. So it's doing good, pretty good so far. That's for sure. But yeah, so I mean, that's kind of an idea of what the offer is. If you could read through that, you get a pretty good feel if you like this, you don't like it, you like the market, not as an investor. And then I think that's when it comes down to the more important documents that you might, well, you will if you want to move forward and you want to actually invest in that syndication. You know, Gary and John, those guys have definitely done these where you create the private placement memorandum and then you do the operating agreement. So Gary, when you talk a little bit about those ones, I know you've definitely had fun with those.
Yeah, and the private placement memorandum isn't as ugly as what it sounds. It's it's over 100 pages, but what makes that up is a portion of that is the offering memorandum, which you've already at this point have reviewed and read, because you decided at this point that it was an interesting deal that you wanted to invest in. So a large portion of that is just stuck in there. Also part of that, the operating agreement is also part of the private placement memorandum. That's in there because it has to be. That's what the LLC is, right? So as a partner on this deal, you are a member of the LLC. So depending upon how many investors you have, all those are members of this LLC, whether you're a limited partner or a general partner, and you need to sign that. You're actually part of that entity, and the entity generally is defined. Sometimes it's named after the property, so you may or may not know what that LLC will be called at the time that you're signing, but that's also a part of it. Also part of it is just the signing pages, so they call that the subscription agreement. So 20 pages of it just might be and some of it's questions. You may be an non-accredited investor, meaning that your net worth is below the threshold to make you an accredited investor, and we want to make sure that you at least have a good understanding of what you're getting into. There'll be questions like how much did you make over the last 12 months, just a range, did you make between 50 and 100 and and then there's some other questions, just trying to get an understanding so that when you do sign it and you've checked off questions that we at least would have some knowledge of what your basic understanding of investment and risk is. So that's nearly 6 or 8 pages of it, and then your signing pages. So there's a bunch of pieces that go into the private placement memorandum. There's a description of the property, actually where it's located, and then some disclosures about it's a risk. You're risking your money. You could actually, you should understand those risks. So that's in there, describing the risks of that. So that's kind of what's in it. It's a big document, but it's just, well, if you break it down into different sections of actually what it is, it's pretty easy to kind of figure out, what it is. And, that could be sent to you electronically. We had some signed in person and some through DocuSign, which, it's kind of a challenge to get things set up so people sign exactly where they need to sign. But, if you're doing things where people are not, easily, within driving distance, you can go about it that way. And then that gets filed with the general partners, and then we'll use that document, especially the signing pages, to pay you your distributions, because within that document, you're going to put in your social security number or your entity, you know, if you're signing as an LLC yourself. And then we need to make payments to you, your distributions and that information. So I go back and I've referenced the private placement memorandums that were signed by our investors at least a couple of times, you know, to collect that information. And then at the end of the year, we need to provide you with a K1. And that information needs to be provided to our CPA so that he can issue those out to the investors. So it's a lot of good stuff in there.
Yeah, yeah, exactly. I've done 2 of them, 3 actually. And yep, I mean, honestly, I still would rather read my PPM though than a mutual fund document. Go read one of those. Those ones will scare you, what they say. So, but yeah. Yeah, so common terms. There's lots of different terms. As you go through the offer memorandum or the PPM, you might see these terms. And once you've looked at a lot of them, you get familiar with this stuff and you understand what the terms are. But we talked a little bit about the active investor, which is a general partner, and the passive investor, which is your limited partner. The acquisition fee, something that Gary said earlier, which is completely true, is the earnest money and the opportunity to actually get into a deal with a potential seller. Sometimes what I've noticed is that people don't really recognize that there is some money lost there in the upfront that an investor never sees, because the deal never got brought to the investor because the group did due diligence, and either they went past a certain point where the money went hard, or they were at least able to stop the deal before the money went hard and they got that money back. But it really depends on the structure and the contract you sign with the seller. But I definitely have heard of other syndicators who've lost 200 grand or more on their EMDs. But they didn't want to move forward with the deal. They just weren't comfortable with going further with it. And, you know, that's a tough loss, but I'm sure they learned from that mistake and restructured their contract a little bit. But yeah, acquisition fees are nice though, because people don't recognize that we could use that to purchase our next asset, you know, to do the MD, to do the other stuff that we have to do, the due diligence, the cost for doing due diligence. So part of the acquisition fee actually can definitely go to that, which is great. So sometimes you'll see where there are groups who don't offer acquisition fees, some that do. If it's something that you don't want to see, you just got to find a group that does that doesn't actually do the acquisition fee. So it's really up to the discretion. But there's different things in here: cash flow, cash return. These are all just very common terms. Due diligence, we talked a little bit about. Earnest money. That's basically, he said 1%. It used to be 1%, but have noticed that it's been going up a lot more, especially if you're in a competitive market. We have seen that as well. Internal rate of return. So basically a complicated math equation, but internal rate of return I've seen where you could compare other types of assets, other types of investments even. So if you have an investment that might be stock related and you have an investment that could be real estate related, they still can provide you an IRR, and that percent can help give you an idea. So if I want to put 100 grand in this deal or 100 grand in that deal, what will my IRR be? So that kind of helps level the playing field. The most important thing that IRR takes in consideration, I think, is time, right? So if you have a deal where you might have doubled your money, but it took 20 years versus one that might have took 5 or 10, you know, what would be a better opportunity? But the thing I also tell people to pay attention to when it comes to IRR is risk. Like some certain things the IRR doesn't take into consideration is where's the location of that property? Is it near gun violence, or is it in a nice suburban neighborhood? So there's lots more to look at in a real estate asset than just the percent and the returns. You also want to weigh in how is the group being conservative when they do their underwriting and removing risk from that opportunity. But yeah, there's other terms that are pretty common underwriting. You know, the process basically of just analyzing the deal. Tax depreciation is great. So if you're somebody who invests in real estate today, you already know this, that, you know, all these assets can be depreciated, and that depreciation can be passed on to your investors. So in the LP, if you own, you know, 50% of that LP, then when we do our depreciation from the CPA's perspective, that 50% gets also passed to you out of that LP portion, which is great. There's a lot of people who just love the depreciation aspect of real estate. Sometimes they focus obviously on the returns, but the things that we don't underwrite are the depreciation that you can have. And that's because everybody's tax situation is different. So when you work with your CPA, you can get a better feel for how much depreciation you can get from an asset or a syndication like this.
And a little bit more on the depreciation. It's a paper loss, right? I mean, the property doesn't really diminish in value, but they let you write it off. So it offsets your income. So on paper, your property, at least for the first, few years of the life of the property, you're going to get a lot more depreciation and offsetting the income. So you're actually going to show a loss. It's one thing that, with my own personal properties, my wife never quite completely grasped. It's like we do our returns to be like, oh, we lost, so much money. It's like, no, we really didn't. It comes out that way on paper. It offsets your income, so actually it helps you because let's say I made $10,000 or $15,000 in rental income, but I had a $20,000 loss. So I get to take that $10,000 loss and offset that from my W-2 job, which is fantastic. It's kind of like a double bonus, right? Because I'm reducing the tax liability on my W-2 job, and I'm not claiming income from the property, which I actually did make money. So, and it's all just funny, right? there is no real loss. Yeah, fortunately, our taxes, get us the ability to write such a hefty loss. But it's one thing that's interesting about that. So people will say, "Oh, you're losing money on it," but secret is no, we're not. The property is not losing money; it's actually making money. But they give you the ability to write that off.
Yeah, it's just the power of real estate. It's another method that it helps build wealth for you, and you could take advantage of the tax system. It's a wonderful tool. It's for those who are not aware, you can do something called a cost segregation study on your property, which basically would just break it down to all the way down to the bolts. And then that firm will come in, they'll look at everything, and then they'll be able to rapidly depreciate a lot of these different types of assets even quicker. So it's pretty cool. It's a pretty cool tool. And real fast on the GP side, I just wanted to break down real quick, just so people have an idea. This was that pie chart up top where we had the GP and then we had LP. Inside the GP itself, like I said, there's different responsibilities depending on what your team might need as a syndicator. Sometimes you might have somebody who just specifically just is the balance sheet guarantor. Maybe they might be a wealthy person who just wants to be able to take advantage of depreciation, maybe of a tax system, or he just wants to create some other income for himself. So he'll come in and provide this responsibility here for signing as John Hancock on the loan, and he'll get some percentage of the GP for that responsibility. You might have somebody who raises money that brings your LPs to the table. So there's just different ways that you could break this down. It's really up to the syndicator. And as the syndicated group grows, they probably might need less people to do this role. But in the early stages, you might have several people who can do that for you. But yeah, any kind of questions on that aspect of it? No. So yeah, that was kind of the gist of it. There's so much more there that you can get really into details and talk for hours, but I figured it'd be a good opportunity just to have you guys ask questions and we can answer them. That'd be more fun. Any kind of question anybody has about syndications and the structures or any of that stuff, feel free to ask. Like we said earlier, you always work with an SEC attorney. This is somebody who professionally creates these documents that gets filed with the SEC. Depending on what type of Regulation D we want to file, we will be able to allow either accredited investors, non-accredited, all that kind of fun stuff. But you are working with a professional SEC attorney. This is not something where we just write up ourselves, type it up and hand it to people. So yeah.
Since this is a new LLC, every time you purchase a new property, whose debt goes into the debt to income ratio? Or is it just based on the performance of the property? Because it's a new LLC and a new entity every time.
You mean the debt coverage ratio on the loans?
Yeah.
So it's based off the underwriting of the property. The bank will do their own.
Right.
They've got their own underwriting that they do, and they take in account the during the due diligence period, you collect the T12 from the prior owner, see what the income is, and then the expenses, and you provide all that to the bank, and they come up with that ratio. Hopefully they're even more conservative than you are, or less conservative, I guess, because we want to be as conservative as possible to make sure that we're not getting into a bad deal. So yeah, they will actually come back to you with that. You kind of get a pretty good feel for what you think it's going to be based on the numbers that you're analyzing, what should be what the same that the bank is analyzing.
They won't ask for each LP's tax returns or anything, right?
I mean, it can depend
No,
on
and they don't even ask for the GP's tax
Okay.
returns. Yeah, nope. It depends on the financing, right? So if it's agency debt and it's a
like Fannie or Freddie or one of those guys.
yeah, just trying to think, a non-recourse loan,
Non-recourse.
right? Meaning that in my case, in John's case, we're not even liable, personally liable for the loan because it's non-recourse. They don't even ask for our stuff. Now, to be honest with you, it was a lot easier, I think, getting that mortgage for the property that we acquired than it was for some of the duplexes I've bought throughout the years, because I've gone through terrible examinations. One time I was buying a property, I had switched jobs, and they were like, it was just a bad timing because I was right in the midst of it, and they got to go back and re-verify everything. Another time I had a check from a relative that had left me small amount of money. Where'd this come from? And all that kind of interrogation. But none of that on an agency debt when it's a non-recourse loan, meaning that the value or the loan is guaranteed against the property, not against the individuals.
Yeah,
Gary, I'm curious. So on Tip Hill, when you did that loan with Sabal, you or John weren't identified as key principals?
We were, yes.
Well, so they would have wanted your financial information as key, because you would have signed the limited guarantees as KPs, right?
The only thing they asked for were signed documents. We had to give them a financial statement, that we
Personal
wrote and
financial
signed.
statement.
Personal financial, yeah. But they didn't verify anything. I mean,
Okay.
I told them how many properties I owned personally, how much money I had in my bank account, and we just signed it. They didn't log in and and really verify that stuff.
Right.
We did have to provide a personal financial statement. Yeah.
Right. So from my 24 unit, we use a local bank, so that is a recourse. So we did have to provide that. We had to provide our tax documents. That was the extent of it, though. I didn't have to do anything else. I didn't get any other detailed questions. A personal finance sheet and my tax documents. So still a lot easier than buying my house. I found.
They probably did run a credit check. I mean, it's almost a year ago, but
Right.
they probably did. But I didn't have to provide any tax information.
Yeah, I mean their focus is the property. If it's an income producing property, if your underwriting matches what they're in the range of what they see, then they understand that business. I always tell people this, like, if you walked into a bank and said, "Hey, I want to borrow $100,000 so I can go invest it in the stock market," they're gonna laugh you out of the bank. They're like, "What are you talking about? Go away, get out of here." But if you want to go borrow $100,000 to go borrow to get a multifamily property that has Bruce's income, they'll say, "Yeah, we'll cover 80% of it for you. Here's a rate." It's just one of the powerful tools of real estate. Yeah. Any other questions? Leverage, yeah. Oh yeah. Yeah. How do you pick an SEC attorney? That's great. A lot of word of mouth. I've traveled quite a bit. Gary and all of us have traveled to different places. We've gone to different events. So you do talk with other syndicators who work with other SEC attorneys. So you definitely get your recommendations and have some conversations with them. To add to that, it's kind of an interview process. So when you're trying to build the team, you're also trying to build a CPA person that you want on your team. You want to build, a broker, you might insurance broker, all these different types of people that are part of your team, your property management company, if you're trying to use just that one company for that area. So you go through an interview process. You just try to get to know these people. You do word of mouth. Same kind of deal that we have to deal with if you have a smaller property and you need to find a contractor and you're like, oh, anybody know a contractor? And you do word of mouth. So it's pretty common still to do it that way as well.
Yep, exactly. We found ours by attending conferences and then through recommendations through the syndication, groups that we've joined and met with. So yeah.
Cool. I actually see a question here from Brad. Yeah, so that's a great question. What projects are we currently targeting? So we're trying to focus more on the B class and newer. I think C's, with the way the market's changed and how the cap's compressed, it's really challenging to try to look at a complete uplift of a C class property. By the time you're done putting a lot of money investing in it and bringing it up to maybe a B level, probably could have bought a B. So something maybe around maybe 1970s, but 1980s newer, garden style type of asset. Honestly, I'm going to be honest, the bigger the property, the easier the numbers work. And honestly, I think sometimes easier the financing. So if you can get something at 100 unit or so, especially if you can have an on-site person, somebody who already can manage the asset for you that it locally can go there versus like a local office, maybe even usually 60, 80, 100, you start seeing where you can do that type of business model. And I think it's easier for the tenants to have somebody who's locally there all the time, which helps. And then in terms of different locations, obviously in our backyard, we live up here. I still think there's certain areas in New York that are good investment opportunities. It's just a little more challenging depending on the areas, but that's why we live here. We know the areas. Like if you told me, hey, I got an apartment complex in the Southwest side, I would say, no, thanks. I know the Southwest side pretty good in Syracuse and I'm going to pass. But there's others that are good. Other markets that we're exploring, I'm actually heading to North Carolina tomorrow. So we're going to look in Raleigh as well as Greensboro area. So our own backyard, Central New York, Rochester, Gary and John they live in Rochester, so they know that area very well. So they're doing business relationships.
And one of the things that we've been working diligently the last few months on is reaching out to sellers directly. So we have purchased some software to help us identify those sellers or the people that are might be interested in selling their property. It's kind of a big database, and it kind of helps you narrow it down and get you the contact information. So we've been working on some mailing campaigns, and that's what we've been busy doing, is trying to find shaking every bush, trying to figure out where we can find sellers in this particular market. So we are working in the Buffalo, Rochester, and Syracuse area. Jamie and Chris have already been targeting the Syracuse area pretty well. John and I are currently working on getting out some letters. Hey, we like to talk to you about possibly buying your building, and it's kind of the efforts that we've been really undertaking at this point here. It's a lot harder to find deals, so you've got to kind of look for different ways of finding those sellers.
Yeah. I see. Also added, we're always looking for investors. You never can have enough investors. It's always good to have an investor database. So anytime we like to at least have a conversation with them, a couple actually, or meet in person, but it's kind of hard to do now. But if people are so comfortable meeting in person, we love meeting in person. I always like going out for coffee or lunch or something with somebody to talk with them, just to make sure that we're a good fit. Make sure that, we know what your goals are as an investor and what you're looking for. And if not, then, we'll try to recommend maybe somebody that we know that might be a good fit for you. But yeah, conferences. Ooh, man.
Yeah, you mentioned conferences. I just wanted to know which conferences you were referring to.
Sure. Yeah. Oh man, I've been to a lot. I think Gary, geez, you and I have been to a couple of the same ones. What are some of the ones you've been to, Gary?
Well, the last one I've been to was we went out to Colorado. Jamie and John and I went out there for the Joe Fairless's Best Ever Conference 2020, and I know you guys have been. I've been to Michael Blank's summit in Reston, Virginia.
Yep.
I think Jamie, you've been out to Dealmaker Live out in Dallas.
Yeah.
So, Michael Blank, Joe Fairless, there's, 5 or 6 more that are, always, holding these conferences. Over the past year, they've just been online virtual events, and, they're certainly not as engaging. Like, we really enjoy the conferences where, you go to these, big facilities, a hotel conference where they've got vendors set up, or, you can, talk to SEC attorneys if you're looking for one, or other people that are selling software that might help you with your business, and they got booths set up. So it's a great place to meet and engage, network. Exactly. So we're really missing that. I can't wait to get back to that.
Me too. Yeah, I mean, some of these places have hundreds. I've seen 700. I went to another one in Boston. Shoot, it escapes me right now. Is it Lindahl? David Lindahl's group there that he started out there. But that one had 700 people, ultimate partnering. That's what it was. Easily 700. So yeah, I mean, you might get a lot of people show up at some of these events, then you can just do some really good networking. So our goal is always to go there, try to meet new people that you never know how you might end up working with each other. I actually just had a text message from somebody 2 days ago, Gary, from our Colorado trip. He was actually, he came over and hung out at the house that we had rented out. And, he just hits me up. He's like, hey man, I was sitting down and I just thought about that place and I thought about you and I wanted to touch base with you. And I'm like, hey, what have you been up to? He's like, yeah, it's pretty cool. So you get some pretty good relationships and friendships, but you also meet other syndicators. You can learn from each other, all that fun stuff. Management companies. Gary, which one are you working with for the 48?
Yeah, we're working with a property management company out of Liverpool. We interviewed, I don't know, 5 or 6 different property management companies when we were looking to find one for our company, our property. It's there are ones that are out there for sure. Good, bad, and in our case, being that it was kind of the first deal that we actually had. They made sure that we had the bank was, insistent that we had a property management company that, held a certain size portfolio. It couldn't just be one that, managed, smaller residential duplexes and stuff like that. We had to have a company that had, a much larger portfolio that they managed. Right. So, there's a bunch of them out there. You can Google them and, look online, and, we interviewed some of the larger ones. CRM is out your way in Syracuse. Trying to think of some of the names there. Sutton Group. Yeah, we interviewed them as well. But yeah, so, we would do that. We would set up an interview and, go talk to them and bring them over to the property and, just kind of get a feel for, how well we thought they would do a job for us, right? Because, you want to make sure that, you're going to be a very good focus for them and, take good care of the property.
What kinds of questions did you guys ask them?
Yeah, tons. It's like, how do they do turnover? What's their process? How do you handle emergency maintenance calls?
Yeah. Are you hire staff? Are you contractors? All that stuff.
Yep. Do you have subcontractors? We had a lot of renovation work that we were planning. So how would they handle that? What's your management fee?
Yeah.
And what do you get for that fee, right? So, really all you get, they talk about the management fee, it could be anywhere from, 3 to 10% or more. You're really just getting the back office, like they're going to collect your rent, they're going to send you monthly statements, they're going to dispatch out maintenance if need be, but everything else is, even the maintenance is charged. Every time someone comes to our property, they charge us hourly, right, to do whatever it is they need to do. Right. And like, other, they don't all do it the same. Like the Sutton Group was different as far as, how they charged you. What is the releasing fee? So if they turn apartment over, do they get a fee for that? And then, what if the tenant that they put in there, doesn't stay? What if they, get evicted, or they're just, turn out to be a lousy tenant, do they guarantee that, or do they release it on their dime, or you got to pay again, so yeah, tons of questions, just everything about, how are they going to manage it? And then, we wanted the ability to be able to have a lot of control. So, that was one of our important things. We didn't want to completely relinquish the control and then just be, because we had a lot of renovation work to do. So the property manager that we chose was like, yeah, if you want to handle your own renovations, go for it. We had a lot of things planned. We had some roofing work to be done, and, we were more hands-on. So we wanted to make sure that we were able to bring in contractors, negotiate the price, and they were, they didn't care. So that was important for us.
Yeah, definitely.
And they didn't charge a fee, right? They weren't going to charge us, 5% for overseeing it.
Yeah, there's definitely a laundry list of questions you can definitely ask them. I still find that word of mouth, finding people who have actually done business with them and worked with them is always great if you can. So that way you can get their personal and professional opinion after they've worked with them. But that same process can be applied to anybody, whether you're dealing with insurance, you're dealing with a plow guy, any of them really. Hey, John, I see a question you have here about any Canadian reach. Are you talking about purchasing properties in Canada, or are you talking about investors from Canada? I think you're on mute though, John. If you can't talk, just type.
Yeah, I'll throw out there while he's waiting for him to come through. Property management, I think one of the things that me and Gary figured out early on is you definitely got to take the time to meet them. I mean, if you do everything over the phone, you can be sold a bill of goods, and by the time you get to meet them, you might be really shocked at what kind of service they might deliver. But just going to see them at their office and see what kind of business they run, the people around them, is really critical, especially when you don't know the business in the area. If you don't know the property management, if you really don't have a good background of what's there, can easily go down a bad path really quick. And I think a lot of people we've met over the years that are in syndications, it seems like they'll go through 2 or 3 different property managers in the bigger cities because they just have problems with them. And I'm not sure if it's because they didn't know well enough to ask the right questions or what, but when you're in a small area like Rochester, Buffalo, or Syracuse, you don't have that many to pick from. So
Sure.
better pick wisely, I guess, and take your time and do due diligence on them too.
Yep. That's a great point. I think that if your goal, like our goal, is to grow, units, and it'd be great if you can find a property management company that wants to grow and can grow with you. And so that's really important. Yeah. Property management is definitely a hot topic whenever you talk about real estate, whether it's your own personal portfolio, that's small stuff, or and you want to grow that, or just contractors in general. Sometimes they mix between property manager and contractors, but it's always a busy topic whenever you talk about that. I see the question. So any building, building something myself, I'm still not totally sure. We're definitely not looking for any assets in Canada. That's kind of what you're asking. But yeah, any other questions, guys? I want to be cognizant of your time and be respectful of it. So I know let's see what time is it here, getting close. Maybe it's about 15 minutes for 8, but definitely want to answer any questions anybody might have. It's definitely a learning curve. I mean, you're always learning something. And sometimes it's not really through something that you're experiencing. You're just talking with another syndicator or investor who's going through something, and you're like, I'm going to have to make a mental note of that, but it's fun. There's a lot of opportunity out there. It just takes a little bit of a grind to find it. That's for sure.
Jamie, all your contact information is through Great Lakes.
Yeah, sure. I'll put it. I'm sorry, I didn't put that up there. I'm gonna pop mine in there. Anybody else want to put their contact info? Feel free. I'll just put mine right here.
Hey guys, while I got your attention real quick, not in March, but in April, which will be 2 meetings down. We're going to have a guest speaker, Julie Peterson from Old Capital Group, which is our broker we dealt with for getting our loans in place. But she's great on the subject of the whole process, any information about what you need to do in order to get a broker and what you might go through, the terminology that gets in that level of stuff. We'll be having her on in 2 months from now. But look out for more information. We'll be sending it out to everybody, but be a great meetup.
Yeah, she's a good person to talk with. There's a lot of good stuff out there, a lot of great people out there. It's, like I said, it's a fun business. If you're interested in investing in something like this, it's education. Read up, ask questions, get a feel for it. Once you get comfortable with it, honestly, the first time I told my wife I was going to go buy $1 million property, she looked at me like I had 3 eyes. And now it's normal. Now it's normal.
3 eyes and 2 heads.
Yeah, she's just like, oh, it's only $1 million. She's just used to hearing that stuff because it's just normal. It's not. Don't let the numbers scare you off. It's not as bad as you think. Awesome.
It's all perspective.
It is. It really is. Yep.
Well, once we find something that's interesting, we are definitely going to be reaching out to everyone, through our Meetup channels. And so stay tuned. We're hoping for something be freeing up, thawing out here pretty soon. So, one thing we like to pride ourselves on is we're open, transparent, ask us anything. We live locally here, so, we're easy to find. We're not going anywhere. I know when you're looking for a place to invest, if you do want to invest, I'm a passive investor, is I want to make sure that I'm investing with somebody that I trust, that has a good track record. So, that's one thing that, I'm sure anyone that has invested with John and I in our, current acquisition there, is pretty happy with what we've been doing. We're pretty proud of the progress that we've made on the property. We put a lot of hard work into it, and our number one priority is to make sure that you get the returns that we proposed in our offering memorandum, and we exceed those, hopefully.
Yeah. All right. Anybody have any other questions? Awesome. Well, I really appreciate everybody joining. Stay warm. And until next time, we'll talk to you guys soon.
Hey guys.
Have a good day. Thanks for joining.
Jamie, find one down there.
Yeah, I'm looking hard.
Have fun. Enjoy. Thanks, guys.
Thanks,
Yeah.
guys.
Good night.
Bye.